Welcome to your presentation for analyzing the balance sheet. Now there are three approaches that we take to analyzing the balance sheet. This video will concentrate on the vertical analysis and the horizontal analysis, or as we know them, the common size and comparative analysis. The ratio analysis is when we really get into good analysis of balance sheet, but it will be in a completely different video as it takes a bit longer to go over. Now, much like the income statement analysis, the common size analysis, we're going to compare it to one common number. Okay? Every line in your balance sheet to one common number. So your common number in this case is either going to be total assets or your total liabilities and owner's equity. We typically just go off of total assets, but you could do the same with your total liabilities and owner's equity, because they should equal the same if it's on a balance sheet, right? So both are going to be 100%. Your total assets and your total liabilities and owner's equity are both going to have that 100% value that we're used to. Okay? We're going to use this to compare it to industry averages for how our balance sheet is split up, other units within our corporation, or percentages from prior periods. So that's how we would use that vertical common size analysis. Our comparative analysis, again, same idea as what we did with the income statement. We're really going to evaluate any big changes, and then we're going to want to investigate any reasons behind those big changes. Okay? We're always going to need two sets of data. So current year versus last year versus budget, versus a similar business unit, industry averages. It doesn't matter really, but to do a horizontal comparative analysis, we need to have two sets of data to do it. So let's look at an example for the C-In Hotel. Okay? So again, I'll do the math a few times with the numbers, and then we'll start to use Excel. So to find out my common size analysis, okay, I would divide my cash at bank for the current year. I would divide that by my total assets. Remember, my total assets are going to be what I compare everything to. Okay, so my 1 million pretty much divided by whatever my total assets are, my $6,076,966. Okay, and you would multiply that by 100 if you're doing it by hand. Since we're using Excel, we'll go percentage and always two decimal places. Okay, so that's how we would find out our cash at bank. Now we can already put our 100% here, by the way, right? Because we know that our total assets for both years and our total liabilities and owner's equity should always be the 100%. It's always going to be the number that we compare everything to. Just think of it that way. Okay. So for our accounts receivable, we go $137,969 divided by, again, my total assets. And turn that into percentage. You would multiply by 100 and keep two decimal places. 2.27% of my total assets are accounts receivable. 16.79% of my total assets is my cash. That's how we would read that. Okay. And now we can start to use Excel. So my inventory is divided by my total assets. Okay, and we'll turn that into percentage. We do the same here. My total current assets divided by my total assets. And again, the way to read it is, when I compare my total current assets to my total assets, 19.43% of what I own is in my current assets. That's how we would read that. And then we would start to do the same here. I'll start to use Excel. And highlight. And now you might go, Mark, how is it possible that my property and equipment is 103% of what I own? It's not possible. Well, that's because we haven't taken into account here our accumulated depreciation. So remember our capital cost allowance. Well, this is the property and equipment at its original value, but it is depreciated over time. So now this is its actual value. It's the net property and equipment, because over time it has depreciated. So this is actually the value of my property and equipment at this moment in time. Okay? So when we come down to our, well, we can do the same here, sorry. And now I'm going to use Excel to speed things up a lot. Every line for my assets will be divided by my total assets. Okay, and then for my current liabilities and all my liabilities and owner's equity, remember there's two ways. I can either divide my $544,398 by my total assets, or I can go by my total liabilities and owner's equity. Because my balance sheet balances, it's the same number, so it doesn't matter. I'll just stick to total liabilities because I'm down here. I'll put absolute, and then I'll just drag down. It's important when completing these exercises that you try it out with the math first, then start to use Excel. So in this case, I would say first practice and make sure that you're going $246,483 and divide it by your total liabilities and owner's equity or your total assets. It's the same number. Okay, to find out that 4.5% of my liabilities and owner's equity is my accounts payable. Okay, but then we could start to use Excel again once you feel comfortable. Okay, I'll make them all percentages. And make sure you're doing it by hand once in a while as well to make sure you feel comfortable with the fact that you have to multiply by 100. So let's analyze now. Now we know that my cash used to be 16%, now it's 11%. Okay, sorry, other way around, make sure you're reading the top. So we actually used to have 11% of my total assets was cash, now it's 16.79%. That means as a percentage of revenues, I've increased how much cash I have on hand. We don't always want to see this too much because what could we be doing with this cash instead is what an owner might ask. An investor may go, why do they have so much cash in their bank? We should be using this to reinvest in the company. Okay. Accounts receivable. So it used to be 1.63% of our total assets. Now it's 2.27%. So we have more accounts receivable as we used to. Okay, so that means more people owe us money. Okay, so we just want to be careful with why this has happened. We might want to look into this. Our inventories used to be used to represent 0.27%. Now they're 0.37%. I'm not too concerned here. My property and equipment, now, it used to be 23% for accumulated depreciation. Now it's 22.29%. The only reason why this number has decreased from last year to this year is because I seem to have more. I seem to own more somewhere here. Okay, so it looks like I purchased more property and equipment. Okay, for my net property and equipment, it represents 80.57% here, whereas before it represented 87.24%. Again, that seems to be because my total assets have increased, and that seems to be because my total current assets have gone through a big increase. That's the only way you could look at that. My accounts payable used to be 4.5% of my total liabilities and owner's equity. Now it's 8.96%. I'm starting to owe more, on the short term. So I want to maybe look into this a bit. Why do we have to go more into accounts payable? Why do we have to owe more money in the short term right now? Since we have so much cash, do we need to owe so much more money in the short term? I would just want to look into it. Now this one would be a big one. Our long-term debt used to represent 6%, let's say, of our total liabilities and owner's equity. Now we've increased it so much that it represents 14.5%. Some of us may say we've taken on a lot more money as a loan. This is a bad thing. But again, it depends on who's asking. As an owner, as a manager, you don't necessarily want to borrow a lot of money. But as an investor, they want to see that you're actually borrowing money instead of using their money to reinvest into the company. Okay? So I'm okay with this, but I'd want to look into it more. Do we need to borrow this money? Can I not be using my cash instead at some points? Different people, different stakeholders will have different ideas as to what you should do here. And then all we would see here is what these are as a percentage of our total liabilities and owner's equity. Okay? So of our total liabilities, our share capital represents 78%. It used to be 86%. So it hasn't really changed. It's just we have more now. Okay? And then retained earnings have actually gone down. So we may have paid out a lot of dividends, or we experienced a loss last year. Because if you see, our retained earnings, our profits at a moment in time, last year, it was a positive number. But now it's negative. That means that we either paid out a lot of dividends or we experienced a loss last year. If you're not too sure how that works, please go back to the statement of retained earnings. As far as our horizontal analysis, our absolute difference is the same. So we would go our current year, which is this year right here, minus the year that we're comparing it to, the accounting period we're comparing to find out that our absolute difference, and I'll put a comma so it's easy to see. So we increased our cash on hand by $424,000. Okay. And then to find out a relative difference, we would divide our absolute difference by the previous period we're comparing it to and turn that into a percentage. Okay, and I'll do the same for each line using Excel. I'll go current year minus previous year. I'll click and drag. Get rid of anything that doesn't actually have any information on those lines. Okay, and then again, I'll go my absolute difference divided by last year. Turn that into a percentage with 2 decimal places. Use the fill function, and I would drag all the way here, and then get rid of anything here. Now, if at any point during these videos you feel like that was too quick, pause it, go back, watch it again a couple of times. Okay, but all I did here was I went my current year minus my last year to find out my absolute difference. For my relative, I divided my absolute difference by the previous period I'm comparing it to. Okay? We should feel comfortable with this because we did it with our income statement. It has not changed. Just make sure you're looking at your headers and know which one is the current year, which one is the previous year. So here we can see that, okay, we increased our cash on hand by 71%. Okay? Again, some people may go, this is great, this is awesome, we have more cash. We should maybe be using this cash though, so I would want to look more into why we have so much cash. We also have more money that's owed to us. Okay, so I would want to investigate this as well. Why? Okay. Our inventory going up by this much as well. Yeah, I want to look at this as well. I would want to look at everything within my current assets here and investigate more as to what's going on. My property, plant, and equipment, so I actually purchased more. Okay, so that's okay. I invested in my company. I purchased more property and equipment. My accumulated depreciation going up. This is, again, we have no control over our depreciation rate. The CCA rate is set for us, so we can't be too concerned about this. And my net property and equipment would basically be the difference between those. Okay, so this we're not too concerned. We're okay with how much we went up by. Okay, and then overall our total assets increased by almost $600,000. Now what we'll be able to see here is of this $600,000 increase, where did the money come from? Okay, so our accounts payable, we owe 120,000% more than we did the previous year. Why do we owe this much more? Okay, I would want to look into this. Long-term debt. Look at how much more money we borrowed for the long term from year to year. $567 $567,000 more in debt. And overall, if you look at our overall debt, we've borrowed $868,000 more. Okay? So of this $593,000 increase, we borrowed $868,000 to get this. Okay? Think of it that way. Now, the reason why there was a difference is because our owner's equity went down. Our retained earnings went down by $274,993. So this means, again, if we had a decrease in retained earnings, this means that we either experienced a loss, a significant loss on our net loss on our income statement, or we paid out a lot of dividends as well as experiencing a loss. So this, I'm concerned because I'm starting to borrow more money. I'm experiencing a loss here. Okay, I'm starting to see a negative number in my retained earnings. Okay, so these are profits over the life of the company. So all of a sudden, over the life of the company at this moment in time, I'm at negative $150,000. Why do I have so much debt if I'm starting to lose money here? We need to be careful here. And then overall, this would be the same as this. Okay, so our total liabilities and owner's equity went up by $593,938. So that's how we would analyze using common size and comparative. The true analysis of a balance sheet really comes from ratio analysis, which will be a video later on.